If you've been sitting on the sidelines waiting for gold and silver to pull back before you buy, I need to tell you something that might be hard to hear. The dip you've been waiting for, it already happened. And if you're still waiting, you've likely missed one of the most significant wealth preservation opportunities in modern financial history. Let me explain what's really happening right now. Because what you're seeing in the precious metals market isn't just another bull run. This is a fundamental restructuring of the global monetary system, and the people who understand what's coming have already positioned themselves. The question is, are you going to be one of them, or are you going to watch from the sidelines as your purchasing power evaporates? Gold just completed one of its most powerful years on record, surging over 60%. Silver delivered its strongest annual performance since the late 70s. And here's what most people don't understand. This wasn't speculation. This wasn't retail investors piling in. This was central banks, sovereign wealth funds, and institutional money managers quietly accumulating physical metal at a pace we've never seen before. They know something. And if you're waiting for a dip, you're betting against the smartest money in the world. Think about what a dip actually means. You're waiting for the price to go down, right? But why would it go down? What would cause gold and silver to suddenly reverse course when every fundamental driver is pointing in the opposite direction? Central banks are buying at record levels. Mine supply is constrained. Industrial demand for silver is exploding. The dollar is losing its grip as the world's reserve currency. Geopolitical tensions are escalating. Debt levels are astronomical. And you're waiting for a dip? Here's the reality. The dip was back when gold was trading in the low 2000s. That was your opportunity. The dip was when silver was sitting below $25. That was your window. But most people didn't buy then because they were scared. The headlines were negative. The sentiment was bearish. And that's exactly when you're supposed to buy. Now that everyone can see the trend, now that the momentum is obvious, now you want to wait for a pullback? That's not how wealth is built. That's how wealth is missed. Let me tell you a story that perfectly illustrates this psychology. Back in the early 2000s, gold was trading around $300 an ounce. People said it was too high. They waited for a dip. It went to 400. Still too high, they said. Let's wait. It went to 500, 600, 700. At every level, there were people waiting for it to come back down. And you know what happened? It went all the way to $1,900 by the time the bull market peaked. The people who waited for the perfect entry, they either bought at much higher levels or they never bought at all. Before I go further, I want to mention something quickly. If you're watching this and you're concerned about protecting your wealth, I've put together a free guide that shows the saving secrets thousands of American retirees are using right now to safeguard their hard-earned money. It's in the description below. No cost, no obligation, just solid information you can use. All right, let's get back to why waiting is the wrong strategy right now. The technical picture tells you everything you need to know. Gold has broken out of a multi-year consolidation pattern. It's established a series of higher highs and higher lows. Every time it pulls back, it finds support at levels that used to be resistance. This is textbook bull market behavior. And in a bull market, the dips get bought immediately. You don't get the luxury of sitting around and thinking about it. The smart money is waiting with buy orders, and they scoop up any weakness before retail investors even notice. Silver is even more interesting because it's been coiling for years. While gold was making new highs, silver was stuck in a range, building energy like a compressed spring. Now it's starting to move, and when silver moves, it doesn't do it gradually. It explodes. We've seen this pattern before. In 2011, silver went from $18 to nearly $50 in a matter of months. The people who waited for a dip during that run, they watched the entire move happen without them. But let's talk about the fundamentals, because this is where the story gets really compelling. Central banks have been net buyers of gold for over a decade now, but the pace of accumulation has accelerated dramatically. We're talking about hundreds of tons per year being pulled out of the market by sovereign nations. China, Russia, India, Turkey, Poland, Singapore. These aren't small players. These are countries with sophisticated financial systems and access to the best intelligence in the world. And they're buying gold hand over fist. Why? Because they see what's coming. The dollar's dominance is eroding. Not overnight, not in a dramatic crash, but in a slow, steady decline that's already well underway. The BRICS nations are building alternative payment systems. Trade is increasingly being settled in currencies other than the dollar. And every time that happens, the need for dollar reserves decreases, which means the need for an alternative store of value increases. That alternative is gold. It always has been, and it always will be. Now you might be thinking, okay, but central banks can afford to buy at any price. What about regular people? What about retirees who need to preserve their wealth? Here's the thing. If you're waiting for a better price, you're making the assumption that you'll get one. But what if you don't? What if gold continues to grind higher, month after month, year after year? What if silver finally breaks out and runs to $40, $50, $60? Are you going to buy then, or are you going to keep waiting? The psychology of waiting is insidious because it feels safe. You're not making a mistake by waiting. You're being prudent, right? You're being patient. But here's what you're actually doing. You're letting fear make your decisions. You're prioritizing the avoidance of short-term regret over the achievement of long-term security. And that's a losing strategy in any market, but especially in a market that's being driven by forces far bigger than technical charts or sentiment indicators. Let me give you another example. In 2008, during the financial crisis, gold pulled back from around $1,000 to $750. People said, see, I told you it would dip. I'm going to wait for it to go lower. It never did. It bottomed at $750 and then went on a tear that took it to $1,900 over the next 3 years. The people who waited for it to go back to $600 or $500, they're still waiting. They missed one of the greatest bull markets in gold's history because they were trying to time the perfect entry. And here's the kicker. Even if you do get a dip, even if gold pulls back 5 or 10% from current levels, what are the chances you'll actually buy? Because if you're scared to buy now, you're going to be even more scared to buy during a pullback. You'll see the headlines screaming about a gold crash. You'll see analysts calling for lower prices. And you'll convince yourself to wait just a little bit longer. That's how people miss entire cycles. They wait for the dip comes, they get scared, and they wait for an even bigger dip. Meanwhile, the market moves on without them. The supply side of this equation is equally important, and it's something most people completely overlook. Gold mine production has been essentially flat for years. We're not discovering major new deposits. The easy gold has been mined. What's left is deeper, harder to extract, and more expensive to produce. That means the cost floor for gold keeps rising. Even if demand were to soften, which it's not, the supply constraints alone would support higher prices. Silver is even more interesting because it's both a monetary metal and an industrial metal. The industrial demand for silver is exploding thanks to solar panels, electric vehicles, electronics, and a dozen other applications. We're talking about structural demand that isn't going away. And unlike gold, silver gets consumed. It's used up in industrial processes and never recovered. That means the above-ground supply of silver is actually shrinking while demand is growing. You don't need to be an economist to understand what that means for price. But here's where it gets really interesting. The paper market for silver, the futures contracts traded on the COMEX, represents far more silver than actually exists in physical form. It's a leveraged system built on the assumption that most contracts will be settled in cash, not metal. But what happens if that assumption breaks down? What happens if a large buyer demands physical delivery? What happens if the industrial users start hoarding because they're worried about supply? You get a squeeze. And in a squeeze, price becomes irrelevant. People pay whatever they have to pay to get the metal they need. We've already seen glimpses of this. There have been periods where physical silver was trading at significant premiums to the paper price. Dealers were sold out. Mints couldn't keep up with demand. And that was just retail demand. Imagine what happens when institutional money decides it wants physical exposure. Imagine what happens when a sovereign wealth fund decides it wants to take delivery of 100 million ounces. The system isn't built to handle that kind of demand. Now, I want to address something that's probably on your mind. What about the risk of buying at the top? What if this is a blow-off top and prices crash? It's a fair question, but it's based on a flawed premise. The premise is that we're in a speculative bubble driven by irrational exuberance. But look at the data. Retail participation in precious metals is still relatively low. Most people don't own gold or silver. Most portfolios have zero exposure to physical metals. This isn't a bubble. This is the early stages of a revaluation. Think about it this way. If you're worried about buying at the top, you're implicitly assuming that the current price is unsustainably high. But compared to what? Compared to the money supply? Gold is nowhere near its inflation-adjusted high from 1980. Compared to the stock market, the gold-to-stock ratio is still well below historical peaks. Compared to real estate, the gold-to-housing ratio is still depressed. By almost any measure, gold and silver are not expensive. They're just less cheap than they used to be. And here's something else to consider. Even if you do buy, and the price pulls back 10 or 15%, so what? If you're buying precious metals as a long-term wealth preservation strategy, short-term volatility is irrelevant. What matters is where the price is 5 years from now, 10 years from now. And if the fundamentals I've outlined are correct, if central banks keep buying, if mine supply stays constrained, if the dollar keeps weakening, if geopolitical tensions keep escalating, then the price is going significantly higher. The question isn't whether you'll see a pullback. The question is whether you'll still be able to buy at anything close to current levels a year from now. Let me tell you about a conversation I had with a financial advisor who specializes in working with retirees. He told me that his biggest regret over the past few years was not pushing his clients harder to add gold to their portfolios. He said he was worried about being wrong, worried about his clients losing money in the short term, worried about his reputation. So he played it safe. He recommended a small allocation, maybe 5%, and told people to wait for a better entry point. And you know what happened? His clients missed the entire move. They're sitting in portfolios that are heavily weighted towards stocks and bonds, both of which are vulnerable to the exact risks that gold protects against. And now they're asking him, should we buy gold? And he's in the awkward position of saying, yes, you should, even though it's much more expensive than it was when I first mentioned it. That's the cost of waiting. It's not just the missed gains. It's the lost opportunity to protect yourself before you need protection. Because here's the thing about insurance. You don't buy it after your house is on fire. You buy it before. And that's what gold and silver are. They're insurance against monetary instability, against currency debasement, against the kind of systemic risks that keep central bankers awake at night. Speaking of which, if you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I've put together a comprehensive guide that walks you through the entire process. How to get physical gold into your retirement account without triggering tax penalties. How to choose a custodian. How to store the metal. It's all in the description below. This isn't about making a quick profit. This is about protecting decades of hard work from the kind of monetary chaos that's becoming increasingly likely. Take a look at the guide. It might be the most important financial decision you make this year. All right, let's talk about what happens next. Because the question isn't whether gold and silver go higher. The question is how much higher and how fast. And to answer that, we need to look at the catalysts that are still in play. First, central bank buying shows no signs of slowing down. If anything, it's accelerating. Countries are diversifying away from dollar reserves, and that trend is structural, not cyclical. It's not going to reverse just because gold goes up another 10 or 20%. Second, the Federal Reserve is in an impossible position. They can't raise rates without crashing the economy and the stock market. They can't lower rates without reigniting inflation. And they can't keep rates where they are without watching the national debt spiral out of control. No matter what they do, the outcome is bullish for gold. If they raise rates, the economy weakens and people flee to safety. If they lower rates, inflation picks up and people flee to hard assets. If they do nothing, the debt problem gets worse and people lose confidence in the currency. Gold wins in every scenario. Third, the geopolitical situation is deteriorating. I'm not going to get into specific conflicts or political situations because they change too quickly, but the broader trend is clear. The world is becoming more fragmented, more multipolar, more unstable. And in that kind of environment, gold is the ultimate safe haven. It's no one's liability. It can't be printed. It can't be hacked. It can't be frozen by a government. It's the one asset that has maintained its value across every civilization, every empire, every monetary system in human history. Fourth, the industrial demand for silver is only going to grow. The green energy transition requires massive amounts of silver. Every solar panel, every electric vehicle, every 5G network. We're talking about structural demand that's going to persist for decades, and the supply isn't there to meet it. We're already running deficits where industrial demand exceeds mine production. That gap is being filled by above-ground stocks, but those stocks are finite. At some point, the market is going to wake up to the fact that there isn't enough silver to go around. And when that happens, the price is going to explode. Now let's address the elephant in the room. What if I'm wrong? What if gold and silver do pull back? What if we get a significant correction? Here's my answer. If you're buying precious metals as a long-term hedge, a correction is a gift. It's an opportunity to add to your position at better prices. But here's the problem. Most people don't have the discipline to buy during a correction. They panic, they sell, they convince themselves that the bull market is over, and then they miss the next leg up. The people who make money in bull markets aren't the ones who time every entry perfectly. They're the ones who establish a position and hold it. They're the ones who understand that volatility is the price you pay for asymmetric returns. They're the ones who can look at a 10 or 15% pullback and see it for what it is, noise. Because in the context of a multi-year bull market driven by fundamental forces, short-term price action is irrelevant. Let me give you a framework for thinking about this. Ask yourself, what's the worst case scenario if I buy gold and silver today? The worst case is that prices pull back and I'm sitting on a temporary paper loss. But I still own the metal. I still have the insurance. I still have the protection against the risks I'm worried about. Now ask yourself, what's the worst case scenario if I don't buy? The worst case is that prices continue to rise. I miss the entire move, and I'm left trying to protect my wealth with assets that are vulnerable to the exact risks I should be hedging against. Which scenario is worse? Here's another way to think about it. Imagine you're standing at the base of a mountain, and you're trying to decide whether to start climbing. You can see that the path goes up, but you're not sure how steep it is or how long it will take. So you wait. You watch other people start climbing. You see them making progress, but you're still not sure, so you keep waiting. And then one day you look up and realize that the people who started climbing are now so far ahead that you'll never catch up. That's what waiting for a dip feels like in a bull market. The truth is, there's never a perfect time to buy. There's always a reason to wait. The price is too high. The market is overbought. There's a correction coming. But while you're waiting for the perfect entry, the market is moving. And the longer you wait, the more expensive your hesitation becomes. Not just in terms of missed gains, but in terms of missed protection. Because let's be clear about what we're really talking about here. This isn't about making money. I mean, yes, if gold and silver go higher, you'll make money. But that's not the point. The point is preserving what you already have. The point is making sure that the wealth you've spent your entire life building doesn't evaporate because you were holding the wrong assets at the wrong time. Think about the retirees who had their savings in bonds during the inflation surge. They watched their purchasing power get destroyed. Think about the people who were fully invested in stocks during the financial crisis. They watched their portfolios get cut in half. Think about the people who trusted that their currency would hold its value only to see it debased by endless money printing. Those people didn't lose because they made bad decisions. They lost because they didn't have the right insurance. And that's what gold and silver are, they're insurance. But unlike other forms of insurance, they have the potential to appreciate in value. You pay premiums on your home insurance, your car insurance, your health insurance, and you hope you never have to use it. With gold and silver, you're buying insurance that could actually make you money while it's protecting you. That's a pretty good deal. So here's my challenge to you. Stop waiting for the perfect moment. Stop trying to time the market. Stop letting fear and indecision keep you on the sidelines. If you believe that the monetary system is unstable, if you believe that central banks are debasing currencies, if you believe that geopolitical risks are rising, if you believe that the dollar's dominance is eroding, then you need to own gold and silver, not as a speculation, not as a trade, but as a core holding in your portfolio. And if you're worried about buying at the wrong time, then dollar cost average. Buy a little bit now. Buy a little bit next month. Buy a little bit the month after that. That way, you're not trying to time the market. You're just systematically building a position over time. And if prices do pull back, great. You'll buy more at lower prices. And if prices keep going up, great. You'll already have exposure. But whatever you do, don't sit on the sidelines waiting for a dip that might never come. Because the opportunity cost of waiting is far greater than the risk of buying. The people who are going to look back on this period with regret aren't the ones who bought and saw a temporary pullback. They're the ones who waited and watched the entire move happen without them. Now, before I wrap this up, I want to make sure you have the resources you need to take action. If you've watched this far, you're clearly serious about protecting your wealth. and I want to help you do that. In the description below, you'll find that free guide I mentioned earlier. But here's something I haven't told you yet. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way to the end, you'll get access to an exclusive one-on-one educational web conference. No obligation, no sales pitch. Just a detailed walkthrough of how to protect your retirement savings using strategies that thousands of retirees are already using. This is only available to people who watch to the end, so if that's you, make sure you mention it when you reach out. The bottom line is this: the dip you've been waiting for already happened. The opportunity was when nobody wanted gold and silver. The opportunity was when the sentiment was bearish and the headlines were negative. That window has closed. We're now in a bull market driven by fundamental forces that aren't going away. Central banks are buying, supply is constrained, demand is growing, the dollar is weakening, geopolitical risks are rising. Every single factor that drives gold and silver higher is in play right now. You can keep waiting if you want. You can keep hoping for a better entry point, but understand what you're really doing. You're betting that the smartest money in the world is wrong. You're betting that central banks, sovereign wealth funds, and institutional investors are all making a mistake. You're betting that the fundamental drivers I've outlined are going to reverse course. And maybe you're right. Maybe gold and silver will pull back, maybe you'll get your dip. But what if you're wrong? What if this is just the beginning? What if we're in the early stages of a multi-year bull market that takes gold to $3,000, $4,000, $5,000? What if silver finally breaks out and runs to $50, $75, $100? Are you going to be positioned for that? Or are you going to be one of the people watching from the sidelines, kicking yourself for not acting when you had the chance? The choice is yours, but make it soon. Because the longer you wait, the more expensive your hesitation becomes. The dip you've been waiting for is gone. The question now is whether you're going to accept that and take action, or whether you're going to keep waiting and miss the opportunity entirely. I know what I'd do. The question is, what are you going to do?